Okay, let's dive right into this explainer because today we are unpacking something genuinely fascinating. We're looking at Range Resources and their Q1 2026 financial results. We're going to see exactly how a company takes raw physical assets buried deep underground and engineers them into a highly resilient financial fortress. Let's break down this playbook. To make this all crystal clear, we'll follow a pretty straightforward roadmap. First up, the Q1 2026 headlines. Second, the Marcellus Shale advantage. Third, reaching global energy markets. Fourth, durable free cash flow. And finally, looking ahead.
All right, Section 1, the Q1 2026 headlines. Let's start right at the top of the earnings release to see the sheer financial impact of their strategy in the first quarter.
Before we get into the heavy math, it's absolutely crucial that we anchor these abstract financials to physical reality. These numbers, they don't just magically appear on a spreadsheet, right? They're generated at active drilling rigs right there in the Appalachian Basin. Literally every single dollar of profit starts with the highly efficient extraction of natural gas and liquids from the ground. Keep that physical reality in mind as we go through these results.
And wow, what a result it was. $619 million. That is Range's cash flow from operating activities for just the first quarter of 2026. Delivering that kind of operating cash flow in a single 3-month period absolutely establishes the sheer scale of their success right out of the gate this year.
A massive driver of that cash flow really comes down to this specific number, $26.62. This was Range's pre-hedge realized price per barrel for natural gas liquids, or NGLs. But here's the so what. Why does that specific number actually matter? Well, because it represents a massive $4.41 premium over the standard Mont Belvieu market equivalent. They aren't just selling their product, they're selling it at a significant premium compared to the benchmark.
To put a human voice to all this data, Range's CEO, Dennis Degner, pretty much hit the nail on the head. He noted that the company is off to a great start, executing a multi-year disciplined growth plan. And look at the real-world results of that discipline. They're funding dividends, they're buying back shares, and they're building literally the strongest balance sheet in the company's entire history. But to really grasp this success, we have to explore the actual mechanics of this disciplined growth plan. How exactly are they pulling this off?
Which brings us to Section 2, the Marcellus Shale advantage. To answer how they achieve these financials, we've got to look at the underlying physical assets that make them possible.
It all kicks off right here. Range is sitting on over 30 years of high-quality Marcellus inventory. Now, for the layperson, inventory in this context basically just means undrilled locations that they already know contain profitable resources. Having 3 decades of this inventory translates to incredible long-term operational durability. They aren't scrambling around trying to find their next project, Their runway for growth is secured for an entire generation.
Now, what's really interesting about this setup is their unmatched contiguous stronghold in southwest Pennsylvania. We're talking roughly 450,000 net acres. And because their land is clustered so tightly together, they can share vital infrastructure, things like roads and pipelines, across multiple wells. This contiguous position is exactly what directly supports their peer-leading capital efficiency and those incredibly low well costs.
And the geology actually offers even more. While they've got those 30-plus years in the core Marcellus Shale, there are additional geological layers beneath and above it. Specifically, we're looking at the Utica, Point Pleasant, and Upper Devonian formations. These act as a massive upside, potentially extending Range's inventory life even further beyond that already impressive 3-decade mark.
Section 3. Reaching global energy markets. Because, let's be real, extracting the gas efficiently is really only half the battle. The real strategy is selling it at a premium.
And this brilliantly illustrates how they pull that off through a highly diversified global sales portfolio. You've got 30% going to the Midwest, 25% heading to the Gulf Coast, another 25% targeting liquefied natural gas and premium Gulf markets, and 20% staying local right there in the Northeast. By piping their product to multiple different domestic and international markets like this, Range essentially bulletproofs itself from sudden price drops in any single region.
So that market diversification directly leads to beating standard market rates. It's the ultimate so what. In Q1, they achieved a $0.18 per MCF premium to the NYMEX benchmark. Let that sink in. That is their highest natural gas premium in over a decade. And they're doing so well that they've actually gone ahead and improved their full-year guidance for NGL prices to a premium of $1.25 to $2.50 over the benchmark.
All right, Section 4, durable free cash flow. So we've got highly efficient extraction combined with premium market pricing. Let's see exactly how this translates into durable investor value on the actual balance sheet.
When you're generating that kind of premium cash flow, you get to reward your shareholders and seriously fortify your company. Just looking at the first quarter alone, Range repurchased $27 million of their own shares. They paid out $24 million in dividends, and get this, they drastically reduced their net debt by an astounding $384 million. They are aggressively utilizing their cash to strengthen their overall position.
Which brings us to an incredibly powerful metric, 0.5x. That is their leverage ratio, measured as debt to EBITDAX. In a cyclical commodity market where prices for gas and oil can, bounce up and down wildly, maintaining the strongest balance sheet in company history with a leverage ratio this low is absolutely vital. It basically acts as an unbreakable shock absorber for the entire business.
So the crucial point here is that this wasn't just some one-off lucky quarter. If we look at the historical free cash flow data over the last 5 years, it shows Range has generated approximately $3.9 billion in free cash flow. Whether commodity prices were booming in 2022 or cooling off in 2023, this proves their overarching strategy of efficient growth and market diversification works sustainably across literally all cycles.
Let's move to Section 5, looking ahead. With such a massive Q1 in the books, what does the rest of the year actually look like?
Well, their operational game plan for the rest of 2026 is wonderfully clear and hyper-focused. Step 1, invest a disciplined $650 to $700 million in all-in capital. Step 2, use that capital to produce between 2.35 and 2.40 BCFE per day. And to put that simply, BCFE just stands for billions of cubic feet equivalent. So we are talking about producing nearly 2.5 billion energy equivalents every single day.
And thanks to some recent upward trends in the market, they've been able to point out a massive upward revision in their guidance. Driven by rising natural gas liquid prices, Range expects to see an additional $160 million in cash flow for the year. This perfectly demonstrates their significant margin expansion potential, right? When prices go up, their super efficient setup captures that value immediately.
We've seen the absolute financial fortress Range Resources has built, but here is the thought I want to leave you with today. We have a company sitting on over 30 years of premier inventory, perfectly positioned for diverse global markets, that has actually successfully maintained net zero Scope 1 and 2 emissions since 2024. As the global demand for reliable, affordable energy continues to surge, how will an energy producer with this specific blend of extreme financial discipline and clean energy practices shape the landscape of our future? It's a genuinely fascinating question and one that makes this space incredibly exciting to watch. Thanks for joining me for this explainer, and keep learning.